Hello everyone, welcome back to the channel. Today we're taking a look at Leggett and Platt Incorporated, ticker LEG. This stock may turn out to be one of my larger regrets if the trends continue as they have been as of late. I currently own 100 shares of this company at $37.46 a share for my average cost. And as we see, after hours, the stock is $32.74. So I'm down a few $100. Nothing crazy. I've held for quite some time and have made quite a bit off dividends. Now that I hold 100 shares, I can sell covered calls. It is not a very high volume stock, so the premiums that it fetches are not the best, and the timelines in which it trades are not the best. So I feel like I am looking for an opportunity to exit this play. I believed in it early on, and this is where you learn not to just believe everything that you hear and see in headlines, because I would follow this one closely, and all the headlines were recommending to buy it. Off of today's headlines, I see Leggett and Platt has a 19% ROE. Is that impressive? As we've seen, to me, that's not impressive. We want to see something at least 30, ideally closer to 60. And that's just one metric where it shows that it's not the type of company that I'm quite looking for. It is definitely a pure dividend play. We see it trading in here. We've kind of been on a downtrend since 2014. We get this bottom here that kind of follows a trend with quite a few touch points on it. And we hit a peak all the way up here when I really believed in the stock. We hit $56, and I believed it was going into the 60s, and we didn't reach it. And then 2021 and 2022 became pretty rough for the company. Now, are they still dealing with those issues? We'll see when we look at the earnings, but I don't see much of a high resistance, maybe somewhere around the $45 range. And for a support, it looks like around $35 may have some sort of action. But this stock is very volatile, bouncing up and down a whole lot. We can get into the fundamentals now and see what's going on there with the stock and what value might be fair for it. And here we have the financials and the balance sheet for Leggett and Platt. We see a lot of yellow and a lot of red. There's nothing pretty about these financials. Top line growth annually, 2.7% is definitely under the range that we like to see. Cost of goods growing, we do not want to see. Gross profit falling, net income falling. Expenses have been shrinking. They did grow this last year. I guess that could be some green that we see. EBIT, we see declining rapidly as of late, nearly 1.9% year over year. The gross profit has been declining relatively quickly. The net income percentage has been declining, again, relatively quickly, especially this last year. And the earnings per share we see declining. Definitely nothing pretty in any of those numbers. Assets, we do see assets increasing. That is something we like to see. Liabilities decreased last year, relatively flat typically. The book value is negative, and we do see that it has been trending in the proper direction. Free cash flows, we see a huge decline. 2019 was an incredible year. 2021 was definitely an outlier. Definitely seemed to typically do somewhere in the $300 million range, which we see in 2022. The share count has been slowly decreasing. It is up from 2019. They did climb it, and they've been reducing it since 2021. Shareholders' equity has been increasing at a pretty decent pace. This last year, it did decline. And the dividend What makes this company so strong? They're a very fast dividend grower, 4.76% this last year. 3.23% is the typical compound rate that we see. They currently yield 5.6%. As a dividend standpoint, it's great. But is it worth having your initial investment eaten away at just to get some cash flow? We see the ROE has been declining fairly quickly. The 25 would have been closer to the range we'd like to see. If there were green flags elsewhere, I'd be okay with that. But the fact that it's declining every single year and we're down to just shy of 19% is a massive red flag for me. The price per share right here, we do see just since 2019, we're down and down and down. This stock has a typical PE of about 16. Right now it's at 13.8. So by that logic, right now it's a little undervalued, but analysts are expecting a much lower year this year. They're expecting $1.59 per share in earnings. The company disagrees with that somewhat, and we'll get into that when we look at those earnings. The dividend yield, this is not really it's what we like, but not what we want to see. You are getting a greater return on your money, but this means that they're paying out a higher dividend while your share price is declining. And that's what the PE is telling me as well, is they're getting higher earnings with a declining share price, and that's why this keeps going down. As of the Lynch formula, this is a overvalued stock. So we see the fair value prices over here. Based off last year's earnings, their typical performance, we'd say 36 would not be a bad value for this. And moving forward, if they do come in at analyst expectations, that 36 drops down to a 25.56. Then we can look at the free cash flow, relatively stagnant. They are strong on free cash flow, which helps them support this dividend. Both the free cash flow and the dividend put it at $50. So if I were looking at this as a pure dividend play, I'd be willing to pay up to $50 for the stock. But we're looking at this more holistically, and we're seeing that maybe that's not fair. Maybe the market is pricing in everything it should be, and it's really closer to a $40 stock. Maybe a little bit of upside from here. I feel like my average cost, $37, would not be a bad price for this company to be trading. But the fact that there's such large declines, especially in the earnings, the market is definitely factoring that in and putting it more towards this $30 share price. And here we are looking at the quarter one results as of today. We'll look at all of these numbers lower down, but I did highlight, as usual, the important things. So they saw a first quarter EBIT of $89 million, down $48 million, or 35% from the first quarter of last year. This was primarily from lower volume and lower metal margins on the steel rod business. The EBIT margin was 7.4%, down from 10.4% in the first quarter of 2022. 2022 numbers were not good, and the fact that we're still seeing these declines makes me think that I might just want to get out of this stock and fetch a better return elsewhere. Although the dividend is tempting to hold on to, it's looking almost like a yield trap. They say that their debt has no significant maturities until November of 2024. Operating cash flow was $97 million, an increase of $58 million versus the first quarter of 2022. So they're building that cash flow. They're able to cut costs, smaller use of cash for working capital, and they're bringing more cash to the bottom line. But that doesn't help the fact that they're not growing the top line. Capital expenditures were $38 million. Their dividend, 44 cents per share for the first quarter, 2 cents higher than last year's first quarter dividend. Net issuance of 500,000 shares through employee benefit plans. Shares outstanding at the end of the first quarter was 133.1 million. we'll look down lower to see how that compares to the last year. Here's their guidance for the year. Sales are expected to be $4.8 to $5.2 billion. So if I just take a look at how they performed last year, they came in at 5.15. So they feel like at the top end, they can come in at what they came in last year, which would be somewhere between -7 and +1%. Earnings per share, they're expecting somewhere between 150 and 190. As I said, analysts had them coming in at 159. If we go to the higher end of this range, we can see that 190 would be a share price based on their typical performance of $30.54. And if they only come in at that 150, even lower than analyst expectations, we'd be looking at $24.11. They say that the metal margins are down mid-teens. They're seeing a lower volume. And with all of that, assuming it's true, they'll have an EBIT margin of 7.5 to 8%. Next, they talk about how their tax rate is 24%. They'll have fully diluted shares of 137 million, of minimal acquisitions and share repurchases. So they saw a bedding product decrease 17%, specialized products increased by 21%, led by hydraulic cylinder acquisition in late 2022, which added 13%. So they are finding some avenues for growth. The fact that that was late August or late 2022 means that we could see more benefit from that throughout this year. And furniture, flooring, and textiles decreased 13%. There was a textile acquisition that added 2%, but volume was down 15%. And then the typical letter, here we go, 8% decline in top line. Cost of goods is down, not too significantly, which leads to a gross profit of 18% less than they had first quarter of last year. We see EBIT down 35%. Net earnings per diluted share at 39 cents compared to the 66 last year, and that is a 41% decline. Common shares outstanding, they had a decline of 0.3. So as we see, it's very minimal share repurchases that they've been doing. Net cash from operating activities is up 148%. So they're really driving that cash. They're converting a lot more of what was previously spent on expenses into cash at the end of the day. And they're paying that out through dividends, which seems to be what they really like to do, is just drive that value to shareholders through their dividend. Their total assets overall are up 2%, right in line. Total liabilities are flat for the current liabilities. Long-term debt is up 2%. Not really what we like to see. We see the different categories here where we can see the margins per category. Bedding products seem to have been decent last year, 11.9% margin. That's not necessarily decent, but that's, looking at all of these, one of the better numbers. Looks like specialized products, their margin is up from 11.8 to 12.3. We see a decline from 10.2 to 7.8 in furniture, flooring, textiles. And the company as a whole, we see a EBIT margin of 11.1, down from 13.9 last year. And that's all that there really is to look at for this stock. Now, my thoughts on it, I'd like to make my money back. It is up 5% after hours, so the market does seem to appreciate the increase in cash flow, because that means that the dividend is likely not at risk, and they'll be able to continue growing that. I'd like to see them be able to grow their top line at a faster rate, and they need to be able to cut those expenses better than they have clearly they're making some progress where it needs to be made, but if they can't bring in cash and they're seeing decreased volumes, then there's not much upside for the actual share value. The ROE decline is concerning. It's at such a low point. I'm not sure that that's worthwhile. It's decent on the PE and the dividend for where it sits today, but if we revisit this in 12 months, it's not going to be decent. And for that reason, I think I'm going to give this one a sell rating. Hold if you think that there's some upside potential. The one thing that they can do is drive a higher total revenue. And the fact that they are at most projecting a 1% increase, that definitely does not keep up with inflation that we've been experiencing and will be experiencing over the coming months and year. So I might just have to wait out a little longer. I do have 100 shares, so I can sell covered calls. Hopefully, you were able to learn about some things that you can look for to be able to determine the performance of a stock. I was buying this way back in 2018, and I just kept growing my position because I was reading headlines. And this is, in all honesty, probably the first time I truly dug into the numbers, and I see that I was wrong. And it's definitely becoming a yield trap that I need to get out of. And hopefully it's not a mistake that you guys will make as well. Thank you for watching, and I'll catch you next time.